Hey everyone, let's talk about something that's messing with all of our wallets lately. Yup, inflation and interest rates. You might hear these terms all over the news, but what do they actually mean for you and your money? Let's break it down in simple terms. First up, what is inflation really? Imagine you could buy a candy bar for $1 last year, but this year, that same bar costs $1.20. That's inflation in action, the price of things going up over time, which means your money doesn't stretch as far as it used to. The government measures inflation using something fancy called the Consumer Price Index, or CPI. Basically, they track how the price of everyday items like groceries, gas, and clothes changes from month to month. So why does inflation happen? Sometimes it's because people have more money to spend and there aren't enough goods to go around. Other times it's supply chain issues or even global events shaking things up. No matter what causes it, inflation eats away at your purchasing power. Now, let's talk interest rates. The Federal Reserve, basically America's central bank, controls something called the federal funds rate. When inflation is high, the Fed often raises interest rates. Why? To slow down borrowing and cool off spending. When it's more expensive to borrow, people and businesses tend to spend less, which can help bring prices down. On the flip side, if the economy is struggling, the Fed might lower rates to make borrowing cheaper, hoping people will spend and invest more. But what does all this mean for you, personally? Well, higher interest rates usually mean higher payments on credit cards, mortgages, and car loans. So if you're thinking about buying a house or carrying a balance on your credit card, those costs are probably going up. On the brighter side, you might also earn more on your savings account or CDs when rates rise, so putting money away could actually pay off more than before. And what should you do about all this? First, try to pay down any high-interest debt, especially credit cards. With rates climbing, that debt gets more expensive fast. Next, consider building an emergency fund if you don't have one. And if you're investing for the long term, don't panic. Markets go up and down, but staying consistent usually wins in the end. Bottom line, inflation and interest rates might sound intimidating, but understanding them helps you make smarter decisions with your money. Keep learning, stay calm, and be ready to adapt. If you found this helpful, hit that subscribe button and share this video with a friend who could use a little financial clarity. Got questions? Drop them in the comments below. I'm here to help. Thanks for watching.